In the last few videos, we've been discussing special issues with revenue recognition. In this video, we're going to talk about less clear fulfillment of the performance obligation. The first common issue we'll talk about is licenses. Licensing fees are paid to access intellectual property. So in this case, the company of interest here sells licensing fees for software, and that's their revenue. The issue here is when performance under the license agreement is fulfilled. And we've got a lot of topics in this chapter. So for now, in this first course in revenue recognition, we're going to defer the issue, but I'm going to tell you that, of course, this can come up at your companies and your clients, and if so, review pages 294 to 297 if you encounter such a licensing arrangement. In a later course, we'll have cases on this transaction for you. Franchises. Franchisors grant rights to sell the franchisor's products and use its name. This usually includes an initial startup equipment shipment plus ongoing products and services. Examples of franchise include McDonald's, Subway, and of course many others. The contracts include upfront payments for the right to use the name, sales of the initial equipment and services, and the ongoing supplier relationships. So think about Subway. You have a fee to be a Subway location. You have the purchase of all that equipment we see in the Subway location. And then you have the ongoing purchase of all the supplies that are sold to the customer. Those are all revenues for Subway, the franchisor. And they're the costs of the goods sold for the franchisee. And then the revenues for the franchisee are our payments to them for the sandwiches and the drinks and the chips and the salads, etc. And so franchises are another type of business that gives rise to less clear fulfillment of the obligation. Another less common one than both licensees and franchisees is bill and hold arrangements and consignment arrangements. Bill and hold means that the revenue has been received. The company sold the physical possession, sold the good, but physical possession was not transferred. So the customer purchased the goods, but requests the seller retain physical possession of the good for a while. Examples: buyers purchases but asks the seller to store the equipment until the site that the equipment is going to be installed is completed. If you incur this in the real world, see the treatment on page 298 of this textbook. Now be careful here if you see this as a user of financial information, because this, in rare cases, could be the underlying method for perpetrating a fraud. This is one of the things where it's done in the classic Sunbeam fraud of several years ago. Another less clear fulfillment of obligation is the consignment relationship, where physical possession is for the buyer before title transfers. So if you're a consignment store, you take the good and you put it in your store, but the person that owns the asset still has title to it. Goods transferred to consignment, but they are transferred to the consignor, but legal title is retained by the consigning company. If the consignee, in other words, the company it has the asset in their showroom, does not find the buyer in an agreed upon time, the good returns to the consignor. The accounting treatment for consignment is discussed in a later chapter in the textbook. Another special issue associated with less clear fulfillment of obligations that is so common that it warrants us speaking more about both now and in a later module within this course is gift cards. Gift cards, I don't need to tell you what they are. They're very, very common. Cards that represent prepayment for goods or services. I give so many gift cards away in the holiday season. In this instance, the seller of the gift card records a deferred revenue at the sale of the gift card, not the revenue itself, but a deferred revenue liability. The deferred revenue is then zeroed out by a debit, and revenue is recorded via a credit when the gift card is presented and used for goods or services at the company. Of course, some cards never get used. Do you ever wonder what happens? Well, in that case, the deferred revenue account is zeroed out, and revenue is recognized at the point where there's a remote likelihood that the holder of the gift card is going to use it. That point in time is a matter of is kind of goes industry by industry, but the company will get a good idea for when enough time has passed that it is very likely that a gift card with no expiration date is not going to be presented. The accounting for gift cards will be discussed further in a later module in this course when we talk about the deferred revenue account associated with the gift cards. For now, I'm going to give you a case, but we're going to talk about it more in general, and then you'll see this case again in a later module in this course. Wine Cellars Inc. sells a vast array of locally produced wines. Wine Cellars gift cards have become a popular holiday gift item. In 2024, the company sold 500,000 of the gift cards. As of the end of 2024, 420,000 of those 500,000 of the gift cards had been redeemed for bottles of wine. And therefore, they became revenue. Experience tells wine sellers that if the card has been outstanding for 10 months or more, it likely will never be redeemed. Now, yes, I will tell you that that's simplistic. We're going to use that so we show the accounting for it in that later module in this course. Of course, a lot of gift cards have no expiration date, and when they do, it'll be many years usually. But for this case, and when we use it later, I put 10 months so we'll actually do the accounting for it at when it is deemed remote probability that it'll be used. In the real world, that's usually an estimated date, but for purposes of demonstrating the accounting, I put in a real date. Of the remaining 80,000 of gift cards at the end of the year, 2024, 10,000 were older than 10 months. So we'll see those being written off into revenue. But for now, I want to talk about a couple of issues. We're going to talk about how much revenue overall will Wine Cellars report in its income statement associated with the gift cards. We'll then show the accounts, debits and credits when the gift card is sold, and the debit and credit of which accounts are debited and credited when the gift card passes the 10-month and still unredeemed threshold. Okay. So with that in mind, and then again with the caveat that we will see this case again in a couple of months, in a month and a half or so, maybe even next month, let's answer these questions. So this is the gift cards case. And the answer to number 1 is $430,000 of total revenue that will appear in the 2024 income statement. That is the $420,000 of the redeemed gift cards sold this year. They sold a total of $500,000, but $420,000 were redeemed, plus the $10,000 that are outstanding at the end of 2024 and are past the date when they're expected to be used. Number 2, when we sell the gift card, remember I talked about it earlier. We debit cash, increase an asset, and credit a liability to increase it, deferred revenue associated with gift cards. When a gift card is redeemed, we zero out the deferred revenue, that liability to deliver goods, because we're doing it right now, and we credit the revenue. And of course, we also have to take the inventory out of inventory by crediting it and debiting the cost of the goods sold. So essentially, it's the same transaction, except rather than giving us cash, they gave us the gift card where they had given us the cash earlier. If a gift card passes the date when it's likely to be redeemed, we will zero out the liability and recognize revenue. Now, I bet the question's in your head, well, what if it then shows up? We certainly still have to perform. Hence, we'll talk about this in that later module, but what we do is we put that liability back on, and then we take it off via the new sale. So we'll see that again in the later module. Okay, and that's gift cards. The last of the common special issues with revenue recognition associated with less clear fulfillment of the performance obligation. And the last topic in this contract, last but certainly not least, as you're going to see in the next video, is the accounting for long-term contracts. Thank you for your attention on all the special issues associated with revenue recognition, and I'll see you in the long-term contract video.